Good afternoon again. So I've got some good news and bad news. Bad news is that you get to hear me talk again. The good news is on a completely different subject, although still on the subject of stress testing and tail risk. You can see that the Centre for Risk Studies on my last day are really getting their money's worth out of me. So this is a project that we started about a year ago now, and it was in collaboration with the Centre for Institute for Sustainable Leadership and 4CMR. And actually I'd like to announce that we are launching this report today. It is Climate Change Sentiment Shock, and in this report we look at what will happen when the financial markets wake up and realise we are on a particular certain climate change trajectory, and then make investment decisions based on that information. And so we look at different scenarios and how the investment community may divest and invest in different sectors across different regions and different asset classes. So you can see here that there have been a number of authors on this project from across the university: Danny, Andrew, Jacqueline, and other people from the Centre for Risk Studies, as well as the Centre for Institute for Sustainable Leadership. In collaboration with our colleagues at the Centre for Institute for Sustainable Leadership, we have done a media release of this, and so far we've had 44 different hits or media outlets taking up this release, this news release, and it was translated in 5 different languages. So it's gone around the world, and leading up to the COP negotiations in Paris, we hope that the communication of this work, of this financial risk, will actually be talked about and make a difference in those negotiations. So to kick it off, I'll give you some key takeaways from this research. Firstly, we believe the reaction of the financial markets to climate change will likely occur well before the physical impacts of climate change themselves. So we all know that there's a risk of physical impacts, but we think that the financial markets will anticipate those risks before they actually occur, and that's what we're trying to model in our scenario. We believe it's the first time researchers looked at the short-term implications of climate change risk, so we're looking at the next 5 years specifically, and the impact on different portfolios, like you've already heard today. Whereas previous studies, what they do is they look at the future impacts of climate change, particularly on the economic side of things, and then discount those impacts into today's dollars. So this is taking a completely different approach and using a sentiment shift of investors for those different climate change trajectories. The results from this analysis show that a climate change investor sentiment shock could cause, in an aggressive portfolio structure, an impact of around 45% of portfolio value. However, with smart investment and hedging, as well as rebalancing across different asset classes, you can mitigate around half of those risks. So that means half of those risks are systematic, half of those risks are unsystematic to the financial sector, and therefore careful analysis of a financial portfolio will enable a knowledgeable and sophisticated investor to mitigate against an investor sentiment shock. We look at 2 extreme scenarios positioned within the 5% tails of the distribution. So we're looking at a no mitigation scenario. Nothing comes out of the climate change negotiations. No one believes anything is going to come of that. And we have a world where climate change runs loose. We have extreme weather events into the future. The other scenario is a 2-degree scenario, which is staying below 2 degrees. We believe both of these scenarios are improbable, and we're likely to be somewhere in between. And so we also model a baseline scenario that we compare these two extreme scenarios against. In both of these scenarios, the short-term impacts on the economy and on portfolios are significant. However, in the long term, the 2-degree scenario ends up being a much more successful strategy for the global economy and for portfolios looking out into the future, into the long-term future. So overall, climate change still represents an aggregate risk driver and must be considered when assessing the performance of assets. So recently, Mark Carney gave a very good presentation at Lloyd's, exactly on this topic of climate change risk, more focused on the insurance sector. And in the report that they released, the PRA released a report looking at the impacts of climate change for the insurance sector. They identified 3 risks, so they almost got it right. I think I've identified other important risks on here. So they identify litigation, transition risk, and physical risk. However, there's some risks here that I think are also important and worth considering. So we all know the typical physical risks. So these are the extreme weather events, the droughts, the floods, that type of thing. We have market risk, which is the focus of our report, looking at how the financial markets may respond to these physical impacts of climate change. We've got litigation risks. So if you're a business that is ignoring the consequences of climate change, then perhaps at some point in the future, your business partners, your clients, your customers may end up drawing a case against you for not considering these risks appropriately. And then, of course, you've got reputation risk. We're already seeing significant impacts in other areas of the role of reputation in damaging financial value. And then, of course, we've got complicating risk factors. So we've got indirect risks. There's seems to be this mentality when you talk to people that countries like the UK aren't going to be that impacted by climate change. You might get a slight increase. Hey, we're going to have warmer weather. But actually, the indirect risks brought about by shocks to the global trading network, the imports and exports from regions of the world that are impacted are going to have a serious impact on the UK, and other impacts like migration are also very important now, but even more so in the future as we get climate refugees seeking new homes around the world. We also have transition risks, so moving to a low carbon economy is a cost, and structural change is required in the economy, so that's a risk that needs to be considered, and how quickly you make that transition is important. And then on top of all this, you have uncertainty. The uncertainty of climate change itself, the uncertainty in the modelling, the uncertainty of everything. Just to stress how this goes right across the spectrum, there are several quotes here. So firstly, I guess this goes, the economics of climate change for me really goes back to Sir Nicholas Stern, where he identified climate change as the biggest market failure the world has ever seen, identified CO2 emissions as an externality that weren't being properly priced in markets. Then you have Mark Carney, who recently called climate change a tragedy of the horizons, where the majority of the costs are going to be picked up by future generations, and once climate change becomes the defining issue, it might already be too late to do something about it. So he's calling for earlier action rather than later, more certainty for the business and insurance markets so that they know what the transition might look like. We have religious leaders claiming there's a moral imperative for dealing with climate change. And then we have Christina Figueres, who's the Executive Secretary of the UNFCCC, saying that climate change is increasingly poses one of the biggest long-term threats to investments. And now research, I think, highlights that it's not just a long-term risk, but it's also a short-term risk as well, depending on how financial markets react to potential triggering mechanisms that occur based on news, technology, policy announcements of climate change. So just highlighting the importance that with climate change, it's the cumulative emissions that matter. On this plot, we have cumulative anthropogenic CO2 emissions on the x-axis, and this is in gigatons of carbon. Up here is in CO2, gigatons of CO2. Up here we have the temperature increase. This is where we are now. We've released around 500 gigatons of carbon, and this is where we need to stay below the 2 degrees limit, which is essentially around 1,000 gigatons of carbon. So it's a nice, easy number to remember, and so we're essentially halfway there. However, you need to take into consideration that we have exponential growth in population, economic growth, and so this target is getting more and more unlikely to be reached. Just a quick quote from Herman Daly: the natural environment is the ultimate means from which human needs and desires are met. So it goes without saying, anything that happens in the natural environment has an impact on the real economy and then on the financial economy. The financial economy takes into account the assets that are in the natural environment, builds those into equity prices, asset prices into the future, discounting those back to today. So if the natural environment, if something happens to those assets, then that has an immediate impact on the financial economy today. Just highlighting some of the major impacts. We have impacts across food resources, so growing food, water scarcity, ecosystem services, and extreme weather events, major impacts here. And then tipping points. We're all familiar with the concept of climate tipping points, permafrost melting, releasing a lot of methane into the atmosphere, accelerating the increase in global temperatures, other risks, Greenland and ice sheet melt, other tipping points where once we go beyond these thresholds, it's very, very difficult to reverse those and go back to a world that we knew before. So the argument is it's better to do something, the risk of avoiding those risks by doing something early than doing something later. And the problem with tipping points is it's very difficult to know when or how much you need to do to stop those tipping points from occurring. The economic damages, so these are some of the estimates that are provided by some previous economists. Here we have Dietz and Stern, Weizmann and Nordhaus is I guess the typical of the economist who's been working on this for a long time. So here we have temperature increases along the x-axis here. Obviously up here we're getting into very uncertain territory, like above 4 degrees is probably the most within the 5% realm, and 2 degrees here, but you can see the difference in the economic damages across the different that economists are estimating the impacts of climate change. So there's still a lot of uncertainty in the economics. The science of climate change is certain, we know it's happening, we need to do something about it. The economics, there's still a lot of uncertainty in estimating what the damages for that are going to be. So just to highlight the relevance of this issue, here are some reports that have been published over since 2007. So along here we have the Stern review, and we have a Mercer report looking at the impacts on portfolios. This is their first report. Then we have stranded assets, which I'll talk about in a bit. Risky business, looking at the impacts across the US on different business sectors and regions. And then we're starting to, this is the second version of the Mercer report here. Then we have the Economist Intelligence Unit producing a report looking at, again, using the discounting approach, what is the impact on financial assets. October this year, we had the PRA releasing this report looking at the impact of climate change on the insurance markets. And then here we've got our report looking at the short-term implications of climate change on portfolios. So very topical. You can see most of these reports down here have all been published in the last 6 months or so. So an increasingly important and relevant issue that we all need to be thinking about. So this is the Economist Intelligence Unit with their analysis, and what they show is that if you look at the present value from the private investor has a discount rate of 7%. They're estimating an asset loss in today's dollars of about 4.2 trillion, compared to a base total stock and managed assets of around 142 trillion. And then on the other extreme, you have, from the perspective of the government, the discount rate of 3.5%, with a 6-degree increase of 43 trillion. So looking at these two extremes, you're looking at a loss of portfolio value between 3 and 30%. So again, a huge range and uncertainty in what's being estimated for what the impacts and the cost of inaction might be. This is a report by Standard & Poor's. Obviously, the impacts of climate change vary across the world, and these are the countries that are most vulnerable to climate change and the impacts that climate change might bring for these regions. And this is showing the disconnect that the fossil fuel companies are projecting based on what needs to happen for climate change. So here we have the Shell Mountain scenario, where we have this section down here, the growth in fossil fuels to 2060. This is BP looking at coal, oil, gas, still growing in fossil fuels, but in order to meet the 2 degrees target, we need to a 60% cut in fossil fuels by 2050. So all of this fossil fuel here, this growth here, it simply can't be burnt. And in fact, the fossil fuels that are in the ground already, that have already been accounted for, that are on the balance sheets of these companies, that are priced into the markets already, have to remain in the ground. And this is what we mean when we say stranded assets. If these assets remain in the ground based on policy or technology, then there's going to be a shock to the energy system, to the companies that own these assets. So initial estimates show that only 20% of existing fossil fuel reserves can be burned in order to meet this existing target. So now I'm going to go over defining our scenario. This is the envelope of our extreme. So this is RCP 8.5. So this is the IPCC projections on what will happen in their worst case scenario, and here is their best case scenario under 2 degrees, and here is our baseline scenarios. These are the 3 scenarios that we look at. But of course, it's not just about the physical impacts of climate change. These are all wrapped up in policy, in economic and demographic projections of different countries, And so there's a whole matrix here of different assumptions. So these are socioeconomic reference pathways, and of course you've got different policy assumptions. So this is kind of a three-dimensional matrix of scenarios, and we chose 3 scenarios that we thought best represented our envelope of describing what might happen in a sentiment shock. So this one here is our no mitigation scenario, high climate change impact, and here down here we have the 2 degrees scenario with an RCP of 2.6 with the sustainable scenario. So what do these scenarios represent? So in the 2 degree scenario, we have energy efficiency and cost reductions in green technology and renewables. We have a global collective responsibility for climate change. So we have an agreement in place to reduce CO2 emissions. We have high carbon tax, removal of fossil fuel subsidies, there are huge fossil fuel subsidies now that need to be removed in order to meet this target, and divestment of fossil fuels. In the baseline scenario, it just assumes that present trends continue, renewables remain trajectory rates, there's no global climate change agreement, fossil fuel subsidies remain in place, no carbon tax, continued investment in old infrastructure, essentially status quo. And in the no mitigation scenario, essentially the worst case scenario occurs. We have increasing concern for irreversibilities. We have new predictions that tipping points have already been reached or are going to be reached very soon. Increasing subsidy for fossil fuels. The decreasing prices of coal and oil continue, particularly in developing countries. We have much larger population growth than was expected. And there's little transfer of technology from the west to the east, forcing them to use old inefficient technology. So this is an outline of our scenarios that we've looked at, and just a summary of some of the variables that we used. Again, we used the Oxford Economics model to look at the sentiment shifts of this short-term impact. And this is just to highlight the important point that it's not just a shift in the average return of a portfolio. So if the distribution stays the same, you'll see the same distribution shifting along, and then you get a decrease, but actually you're getting a shift in the shape of the distribution as well. So your value at risk, here you're getting a fattening of the tails as well, and that needs to be considered in your analysis. So when we do Oxford Economics, we get a time series output, and so we're able to look at what this 5% bar is at a quarterly level. So here are the main results. Short-term economic impacts, we see, so this is the baseline, the yellow line here, and we see in the 2 degree scenario, it's below baseline, and the no mitigation scenario is also below baseline. So even if we do something about climate change, it's going to have a short-term economic impact. It's going to mean a transition to a low-carbon world that's going to be costly. The economic structure has to change. Carbon tax is going to have to be put in place, and the energy, and there's going to be stranded assets that are in the ground from the fossil fuel companies that are already on the balance sheet of these companies that are going to be a decrease in the equity values of these fossil fuel companies. So these, in this scenario, we're looking at a 9 trillion GDP at risk, the 2 degree scenario, and a 20 trillion in the no mitigation scenario. So a doubling the cost between here. But if we look at the long term, we see what tends to happen is the economy rebounds. Here we get higher growth occurring in the 2 degree scenario, and in the no mitigation scenario we get continued bombardment from the future effects of climate change. So now taking these impacts through to the portfolio level, 5 minutes, we're looking at essentially 5 different regions, different asset classes, and 4 portfolio structures. We've already seen these. Essentially, we did these in negotiation with the investment leaders group to align with their investment portfolios. And this is I guess the key sectoral impacts in the emerging markets. Energy, oil and gas having the highest volatility here, up to health and pharma being a much better investment and lower volatility. And again, for the developed markets, we have real estate being heavily impacted, so capital infrastructure, essentially construction, basic materials being the most impacted sector, and over here we have consumer, retail, transport and agriculture being the less impacted sectors. So these are the overall results for the portfolio impacts. The 2 degree scenario, essentially it's very hard to mitigate against a systematic change, so we're getting decreases across all portfolios of similar magnitudes. In the no mitigation scenario, the aggressive portfolio has a shock of 45% compared to the higher fixed income portfolio of minus 23%. Then when we look at the portfolio after 5 years' time, we see the 2 degree scenario actually has much better returns, with a 25% increase for the aggressive portfolio compared to a negative 45. So after 5 years in the no mitigation scenario, the portfolios don't recover. So the 2 degree scenario, even though there is a short-term impact, the portfolios do recover over time. So the high-level conclusions, what you can do if you're a business owner, asset manager, insurer. Firstly, estimate the carbon footprint of your business. If you don't know it, this is a good first step. Then estimate the carbon footprint of all your trading partners, all the supply chain, anyone that you do business with, and try and use that information to reduce your carbon intensity. Divest from carbon intensive products and services. There's actually a nice little anecdote of an investment fund, a pension fund, actually AP4, who had the idea of divesting from carbon intensive assets. So what they did was instead of just divesting from fossil fuels and then taking themselves out of that sector completely, they did a complete analysis of all the companies and sectors in their portfolio. Initially they were tracking the S&P 500. They took those 500 companies and got the best performing sectors in terms of their carbon emissions, removed them from their own portfolio, and surprisingly those companies that they invested in tracked at the same rate what they were getting before. So they were reducing their carbon intensity of their portfolio by over half, and they were getting the same returns on their portfolio. So there's this sometimes this belief that investing in low carbon products is going to cost money, or you're not going to get high returns. There's a clear example that a company that has done this shows that it's to be true. And when the manager of this asked why this might be the case, they said it was because the managers of these companies that were aware of their carbon footprint that were managing were actually very good managers as well, managed the business, managed their finance as well. So perhaps it's an instrument for looking at good business management. But then to decorrelate and diversify your carbon and climate risk, then again perform stress tests, the type of stress tests that I've been describing today, both on the short term and the long term. Think in systems. What are the ongoing impacts, what are the indirect effects of climate change? How might this impact your business model? And then of course cooperate with others to build standards, to lobby, to make sure you can get certainty over these transitions, because the thing that I think everyone wants to avoid is shocks and uncertainty moving into the future. So that's a quick overview of the unhedgeable risk. Download it now from the Centre for Risk Studies website, and email me any questions you have, or you can ask me now if there's time.
Yeah, can we just set up Eugene while I think we'll take a couple